I need you to pay very close attention to what I'm about to share with you because what's happening in the silver market right now is something I haven't seen in over a decade of analyzing precious metals. And I'm not talking about some minor price fluctuation or typical market noise. I'm talking about a convergence of factors that's creating what could be the most explosive setup in silver's modern history. Let me start with something that happened just 72 hours ago that most people completely missed. The Shanghai Futures Exchange reported a drawdown of physical silver inventory that was so dramatic, so unprecedented, that when I first saw the numbers, I had to double-check them 3 times. We're talking about a 23% decline in registered silver stocks in a single week. Now, you might be thinking, okay, inventories go up and down all the time, and you'd be right. But here's what makes this different. This isn't happening in isolation. This is happening while COMEX inventories are simultaneously hitting multi-year lows, while industrial demand is surging to record levels, and while the gold-to-silver ratio is sitting at levels that historically have preceded massive silver rallies. Let me paint you a picture of what's really going on behind the scenes. There's a major electronics manufacturer in South Korea, and I'm not going to name them because this information comes from a supply chain contact, but this company just secured a 3-year forward contract for silver at prices that are 40% above current spot. Think about that for a second. Why would a sophisticated corporation with teams of analysts and procurement specialists agree to pay 40% premiums for future delivery unless they knew something about where this market is headed? They're not doing this out of charity. They're doing this because they've run the numbers, and they understand that the alternative, waiting and hoping to buy silver at lower prices, carries a risk they're not willing to take. And they're not alone. I've been tracking industrial silver purchases, and what I'm seeing is a pattern of panic buying that reminds me of what happened in the palladium market back in 2020, right before prices went absolutely parabolic. You've got solar panel manufacturers in China stockpiling 6 months of inventory when they normally carry 30 days. You've got automotive companies that are supposed to be just-in-time manufacturers suddenly building strategic reserves of silver-bearing components. This is not normal behavior. This is the behavior of companies that have looked at the supply-demand fundamentals and realized they're staring at a potential crisis. Now, let me take you inside the COMEX for a minute because what's happening there is absolutely fascinating and terrifying at the same time. The COMEX is where the paper silver market operates, where futures contracts get traded, where prices get discovered. And right now, the ratio of paper silver claims to actual physical silver available for delivery is approaching 400 to 1. Let me say that again. For every ounce of physical silver that actually exists in COMEX vaults, there are 400 ounces worth of paper claims against it. This is a system that only works as long as everyone agrees to play along, as long as most contract holders agree to settle in cash rather than demanding physical delivery. But here's where it gets interesting. Over the past 6 weeks, we've seen a dramatic increase in the percentage of contracts going to delivery. Normally, maybe 2% of silver futures contracts result in actual physical delivery. The rest get rolled forward or cash settled. But in the last delivery period, we saw that number jump to 7%. And in the current delivery month, early indications suggest it could be even higher. Now, 7% might not sound like much, but in a market this leveraged, in a system this fragile, it doesn't take much to break it. If that number gets to 15% to 20%, the entire structure starts to crack. And you know who understands this better than anyone? The central banks. Now, central banks don't typically hold silver the way they hold gold, but what they do hold is gold. And what they're doing with their gold right now is sending a very clear signal about where they think this monetary system is headed. In the third quarter alone, central banks added 337 tons of gold to their reserves. That's the highest quarterly purchase in over a decade. The People's Bank of China has been buying gold for 18 consecutive months. The Reserve Bank of India just repatriated 100 tons of gold from the Bank of England. Poland's central bank announced they're targeting 20% of reserves in gold. Why does this matter for silver? Because silver is gold's little brother. It's the poor man's gold. And historically, when gold starts moving, silver follows with much more volatility. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is currently sitting at 88 to 1. The historical average is 60 to 1. The natural occurrence ratio in the Earth's crust is about 17 to 1. What this means is that silver is dramatically undervalued relative to gold. And when that ratio starts to compress, when it starts moving back toward historical norms, the moves in silver are explosive. Let me tell you a story about what happened in 2011. I remember it vividly because I was watching it unfold in real time. Silver started the year around $30 an ounce. By April, it had touched $49. That's a 63% move in 4 months. And what triggered it? A combination of factors that look eerily similar to what we're seeing right now. You had QE2 pumping liquidity into the system. You had concerns about sovereign debt in Europe. You had industrial demand from emerging markets. You had investment demand from people who were worried about currency debasement. And you had a supply situation that was tight, but not nearly as tight as what we're looking at today. Because here's something most people don't understand about silver supply. Unlike gold, which is primarily mined as a primary product, about 70% of silver comes as a byproduct of mining other metals, zinc, lead, copper, which means silver supply is not very responsive to silver prices. If silver goes to $50, $60, $100 an ounce, you can't just open up new silver mines quickly. The lead time on a new mine is 7 to 10 years. And right now, the pipeline of new silver projects is the thinnest it's been in 20 years. We're looking at a situation where annual silver demand is running about 1.2 billion ounces, and annual mine supply is around 830 million ounces. That deficit has to be made up from above-ground stocks, from recycling, from investor selling. But what happens when investors stop selling and start buying? And that's exactly what we're starting to see. Silver ETF holdings, which had been declining for 2 years as investors rotated out of precious metals, have started to tick back up. It's early, it's subtle, but the trend has reversed. The U.S. Mint reported that Silver Eagle sales in November were up 40% compared to October. Dealers are reporting premiums on physical silver that are the highest they've been since the COVID panic of 2020. I'm seeing premiums of $6, $7, even $8 over spot for retail products. That's not normal. That's a sign of a market where physical demand is overwhelming available supply. Now, let me shift gears for just a moment, because if you're sitting on retirement accounts, if you've got $100,000 or more in traditional IRAs or 401ks, there's something you should know about. I put together a comprehensive guide on how gold IRAs work, how you can get physical precious metals into a tax-advantaged retirement account without triggering penalties or taxes. It's completely free. It's in the description below. It covers the mechanics, the custodians, the storage requirements, everything you need to know. If that's relevant to your situation, if you're thinking about diversifying some of your retirement savings into hard assets, it's worth checking out. But let me get back to what's happening in this market right now, because the timeline is compressing. The reason I titled this 72-hour warning is because we're approaching a critical juncture. December 13th, which is 72 hours from now, is the last trading day for the December silver futures contract. This is when we're going to see exactly how many contract holders are demanding physical delivery versus rolling forward or settling in cash. And based on the open interest numbers, based on the inventory levels, based on the positioning of the commercial traders, I think we could see something break. Not guaranteed, but the probability is higher than I've seen it in years. Let me show you what the commercial traders are doing, because these are the smart money players, the ones who actually deal in physical silver, the miners, the refiners, the industrial users. The Commitment of Traders report, which comes out every Friday and shows the positioning of different trader categories, just showed that commercial traders have reduced their short position in silver to the lowest level in over 3 years. Now, why does that matter? Because commercial traders are typically short silver futures as a hedge against their physical holdings or their future production. When they reduce those shorts dramatically, it means one of two things. Either they've sold physical silver and don't need the hedge anymore, or they're expecting prices to rise and they don't want to be caught short. And here's the kicker. At the same time, commercials are reducing shorts, large speculators, the hedge funds, and managed money are still relatively underweight silver. Their long positions are well below the levels we saw in 2020, well below the levels we saw in 2016, which means there's a massive amount of potential buying power sitting on the sidelines. If this market starts to move, if we get a breakout above $32, above $35, you're going to see a flood of momentum money come rushing in. And in a market as small as silver, with a total market cap of around $1.4 trillion compared to gold's $15 trillion, it doesn't take much money to move the price dramatically. Let me give you some context on just how small the silver market really is. The entire annual silver market, all the silver mined and recycled in a year, is worth about $25 billion at current prices. That's less than the market cap of many individual tech stocks. That's less than what flows through the treasury market in a single day. if even a small percentage of the money that's currently sitting in bonds, in stocks, in money market funds, decides to rotate into silver as an inflation hedge, as a monetary alternative, the impact on price would be enormous. And there are signs that this rotation is beginning. I'm seeing it in the options market. Call option volume on silver has been surging. The open interest in out-of-the-money calls strikes at $35, $40, even $50 has been building steadily. These are bets that silver is going to move significantly higher, and they're being placed by traders who are willing to put real money behind that conviction. The implied volatility in silver options has been creeping up, which tells you that option sellers, the market makers, are demanding higher premiums because they see increased risk of large price moves. Now let me connect some dots that most analysts are missing. We're in the middle of a global monetary reset, whether people want to acknowledge it or not. The BRICS nations, Brazil, Russia, India, China, South Africa, just expanded to include Saudi Arabia, UAE, Egypt, Ethiopia, and Iran. This bloc now represents about 45% of global population and 35% of global GDP. And they've been very explicit about their intention to reduce dependence on the US dollar for international trade. They're settling oil transactions in yuan. They're using local currencies for bilateral trade. They're building alternative payment systems to SWIFT. What does this have to do with silver? Everything. Because as confidence in fiat currencies erodes, as the dollar's role as global reserve currency gets challenged, people and nations look for alternatives. Gold is the obvious choice, and that's why central banks are buying it at record pace. But silver is gold's more accessible cousin. It's the metal that ordinary people can afford to accumulate. It's the metal that has both monetary properties and industrial applications. It's the metal that could serve as a bridge between the old monetary system and whatever comes next. And here's something that keeps me up at night. The strategic importance of silver is not just monetary. Silver is absolutely critical to the green energy transition that governments around the world have committed to. Every solar panel requires about 20 grams of silver. Every electric vehicle uses 25 to 50 grams of silver in its electrical systems. 5G infrastructure, which is being rolled out globally, is heavily dependent on silver for its conductivity properties. The Silver Institute estimates that industrial demand for silver is going to grow by 15% over the next 3 years, driven primarily by solar and electronics. But here's the problem. That demand growth is baked in. It's coming whether silver prices are $25 or $50 or $100. Because if you're building a solar panel, the silver cost is maybe 5% of the total panel cost. Even if silver doubles in price, it's not going to stop the solar build-out. The economics still work. But what it does mean is that there's a floor under industrial demand that didn't exist in previous decades. In the 1980s, when silver hit $50, industrial users could substitute away, could find alternatives, could reduce consumption. Today, with silver embedded in critical green technologies, that substitution is much harder. Let me take you back to a moment in history that I think is incredibly relevant to what we're seeing now. In 1979, the Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, tried to corner the silver market. They accumulated massive positions in physical silver and silver futures, driving the price from $6 in January 1979 to $49 in January 1980. The exchange changed the rules, raised margin requirements, restricted trading, and the price collapsed. The Hunts were wiped out. Silver crashed back to $10. But here's what's different today. The Hunt brothers were trying to artificially manipulate a market where supply and demand were relatively balanced. They were using leverage and speculation to create a squeeze. What we're seeing today is not manipulation. It's fundamental supply-demand imbalance. It's industrial users competing with investors, competing with monetary demand in a market where above-ground inventories are declining and new supply is constrained. You can't change the rules to fix a fundamental shortage. You can't regulate away the fact that solar panel manufacturers need silver and there's not enough to go around. And the geopolitical dimension adds another layer of complexity. China controls a significant portion of global silver refining capacity. If tensions between the US and China continue to escalate, if we move toward a more fragmented, block-based global economy, the free flow of silver from refiners to end users could be disrupted. We've already seen China restrict exports of gallium and germanium, critical metals for semiconductors. What's to stop them from restricting silver exports if it serves their strategic interests? I want to show you what's happening in the physical market right now because it's telling a very different story than the paper price. I track dealer inventories across major bullion dealers, and what I'm seeing is inventory levels that are 40% below where they were a year ago. Delivery times that used to be 2 to 3 days are now 2 to 3 weeks for certain products. Premiums that used to be $2–3 over spot are now $6–8. This is not a market that's in balance. This is a market where physical demand is straining the distribution system. And it's not just retail. I'm hearing from contacts in the wholesale market that large bars, the 1,000-ounce bars that trade in the institutional market, are getting harder to source. Refiners are running at full capacity, but they're struggling to keep up with demand. The spread between London and New York silver prices, which is normally just a few cents, has been widening, which suggests that the physical arbitrage that normally keeps these markets in sync is breaking down. Now, I want to address something that skeptics always bring up. They say silver has been a terrible investment for the last decade. It peaked in 2011 and went nowhere. And they're right about the price action, but they're wrong about the conclusion, because what's been happening over the last decade is that the market has been setting up for what comes next. Weak hands have been shaken out. Speculative excess has been wrung out. Supply has been constrained as low prices made marginal mines uneconomic. Demand has been building as industrial applications have expanded. The spring has been coiling tighter and tighter. And we're starting to see the technical setup that precedes major moves. Silver just broke above its 200-day moving average after being below it for months. It's forming what technical analysts call a cup and handle pattern on the weekly chart, which is typically a bullish continuation pattern. The RSI is in neutral territory, not overbought, which means there's room to run. Volume has been increasing on up days and decreasing on down days, which is a sign of accumulation. But technical analysis only matters if the fundamentals support it. And the fundamentals in silver right now are the most compelling I've seen in my career. You've got supply deficits that are structural, not cyclical. You've got industrial demand that's growing and price inelastic. You've got investment demand that's just starting to wake up. You've got monetary demand as people look for alternatives to fiat currencies. You've got geopolitical tensions that threaten supply chains. And you've got a paper market that's leveraged to a degree that makes it vulnerable to a squeeze. Let me tell you what I think happens next. I think we're in the early innings of a move that could take silver to $40, $50, potentially higher over the next 12 to 18 months. I think the catalyst could be a delivery squeeze on the COMEX, or a major industrial user announcing supply difficulties, or a shift in Fed policy that weakens the dollar, or a geopolitical event that drives safe haven demand. But the underlying conditions are in place. The powder keg is loaded. It just needs a spark. And here's the thing about silver. When it moves fast. In 2020, silver went from $12 to $30 in 4 months. In 2011, it went from $18 to $49 in 8 months. In 1979 to 1980, it went from $6 to $50 in 12 months. These are not slow, grinding moves. These are explosive, momentum-driven rallies that leave people who wait on the sidelines watching in disbelief. So what should you do with this information? I'm not going to tell you to buy silver. I'm not a financial advisor, but I will tell you to do your own research. Look at the inventory data. Look at the supply-demand fundamentals. Look at what central banks are doing. Look at what industrial users are doing. Look at the technical setup, and then make your own decision about whether this is an opportunity you want to participate in, because 72 hours from now, we're going to have a lot more clarity about whether this market is about to break. We're going to see how the December delivery period plays out. We're going to see whether the physical demand that's been building actually overwhelms the paper market's ability to deliver. And if it does, if we see a squeeze, if we see a scramble for physical metal, the price action could be unlike anything we've seen in decades. The silver market is small, it's volatile, and it's setting up for a move that could define the next phase of the precious metals bull market. The warning signs are flashing, the fundamentals are aligned, the technical setup is in place, and the clock is ticking. This is not a drill. This is not hype. This is a convergence of factors that happens maybe once or twice in a generation. And if you're a silver stacker, if you understand the role that precious metals play in a portfolio, if you're paying attention to what's happening in the monetary system, then you need to be ready for what comes next. Because ready or not, it's coming.